Hey everyone, welcome back to another episode of AWM Insights. Thanks for tuning in. It's Justin Dyer holding things down as the host, Chief Investment Officer here for AWM, joined on my right hand side here by Mena, Hanna, Portfolio Manager at AWM. We're going to cover a couple topics today. One is focused just on quarter end. So we wrapped another quarter, third quarter of the year, 75% of the way home. And so far, it's definitely been a strong year, but it's certainly been interesting. And the present moment is definitely very, very indicative of that. We unfortunately just saw that the government shut down. Hopefully, by the time this goes to air, it is resolved. I don't think too many people are holding their breath. And we've seen, all sorts of headlines around the economy, and the markets just plowed right through them for the most part. It's been a very, very strong year across the board. Emerging markets, international developed markets, and U.S. markets all putting in very, very solid numbers. If we're looking at ETFs that represent those certain asset classes, we're looking at very, very strong double-digit returns. Emerging markets at the top there, north of 30%. Developed international at 26%, just north of 26%. And then U.S. markets, looking at the S&P 500, around 14%. So a super strong year. And we hope that obviously continues as we wrap things up for 2025. But one of the things, given the timely topic of government shutdown, wanted to just address that head on. So, Mena, take it away.
Yeah, and I just want to say it's been a long year. It's been a great year. We've been through a lot. There was the tariff tantrum, a lot of geopolitical events. This whole government shutdown, I think, is just going to be a walk in the park relative to what the markets have overcome recently. But looking at the data, the market has shut down 11 times since 1981. And the longest shutdown actually was in 2018 under the same administration. And it really wasn't that big of a deal. It shut down for 34 days. Markets actually did fall around 4%, but it had nothing to do with the government actually shutting down. It had to do with interest rate policies. There was a little bit of talk of rising interest rates. Markets really didn't like that. They fell 4% roughly around the same time that the government actually did shut down. And then over the next 30-ish days, markets actually rose 12%. So in this period of uncertainty where the government was shut down, there's a lot of arguing around what's actually going to get passed, what's the budget going to look like, ton of uncertainty, which markets don't like. Even in the face of all of that, over a 34-day stretch of time, markets ended up 8.5% up to the good. So I think it's a good takeaway to understand that a government shutting down is a very, very small impact. Does it impact us economically? Of course. But the economy is not the market. And ultimately, there is so much more out there than just the government, and a lot more relevant factors, whether it's interest rates, tariffs, inflation, corporate earnings. Those are all significantly more important. And actually, these are factors that move markets. So a government shutdown is, not the best thing to see, but it's not something that is going to significantly change our short or long-term outlooks on any asset class, really.
Yeah, that's super helpful. And like I said, hopefully this one is not long lasting and in no time it's resolved, but we'll see. It shouldn't have material impacts on the market. Like you said, the broader underlying fundamentals of company earnings, corporate earnings, et cetera, are really what truly matter. All right, we're going to shift gears a little bit of a left turn, but we did get an inbound question and we wanted to address it around how different generations think about investing. One way I want to kind of reframe that question, like kind of what's the question underneath the question is, and we'll get to this at the end, is how how should each generation think about investing, right? There's both how different groups of individuals in different ages, right? We kind of talked about that in the last podcast around if you're in the accumulation phase of your life versus the distribution or spending phase of your life, how should you think about building a portfolio? And this is kind of a similar version of the same question, but let's get into at least how we're observing the differences, Mena, and then we'll conclude with our take on actually what we think on how each generation should actually invest.
Yeah. And it's really, I'd say it's very different. I wasn't expecting the results to be as different as they are, or our findings to be as different as they are. But I guess looking back at it, it kind of makes sense. If you're a boomer, if you had an easier life, for the most part,
that's a loaded term there. Watch out.
Buying a house was easier. You made more money on a relative basis. You could buy something like a Corvette for $4,000 back in the day. You have just more of an opportunity to succeed. And also just being older, you have more time if you are saving money to compound that money to actually build value in an investment account via your retirement savings, all of those general areas, versus some of the newer generations and their learned experiences, I would say, witnessing potentially the run up in tech stocks, the run up in large caps, witnessing crypto kind of explode, also being on social media and seeing influencers, crypto traders make an absolute killing. Like all of these little micro experiences, I would say, impact how everyone observes and views wealth accumulation, views the concept of investing, of saving, of what am I actually trying to do with any disposable income that I do have. So yeah, all interesting points, but I guess I was very critical of boomers. What's your take on boomers investing sentiment?
Yeah, I mean, I think there's I would just agree with what you're saying, right? Each and every generation is a product of reality or their lived experiences. So I think you can argue that boomers were able to start earlier. Let's not use the term they had it easier, but they were able to start earlier. Then we move on to Gen Xers. Not all that dissimilar, but I think to your point, they had a little bit more of a rocky, formative period of their life. And so they're a little bit more conservative and focus on saving for retirement as opposed to growing wealth. And then you transition into millennials, and they're kind of the split generation. If you look at surveys, et cetera, and investing and savings type surveys, where they're like a hybrid between boomers and Xers and Gen Zers as well. There's a kind of a blend of traditional investing beliefs and more risk taking into you could call it frontier assets or crypto, et cetera. That's a loaded term, and there's a lot behind crypto and blockchain, et cetera. We've talked about that, and maybe we'll talk about that in greater detail in a future pod. But just in general, I think there's more willingness, and part of that is because it's hard to get ahead, and they think, at least again looking at survey data, they think they need to take more risk to get ahead, or they can't afford to buy a house. If you look at Gen Zers, so I've read some articles that the belief is that they will take risk both to get ahead or because there is no alternative kind of mindset. So there are these differences, but what we want to do is reframe the question, which is good. I think it's very interesting, kind of from a sociological standpoint to see how people are formed and shaped, et cetera. And it does have some implications for investing. But if we go back to how we view investing and ask the question, how should every generation invest? It does go back to a lot of what we talked about in that last podcast. And the through line here is discipline, right? Whether you're talking about a Gen Zer who maybe doesn't have as much additional income to save, you still need that discipline to save, right? Whether you're investing in crypto or saving to buy a house. Boomers, same idea. They needed discipline. Maybe it took them, 50% less time to get there, but that discipline is critical. And then we would advocate very, very heavily for very much a data-driven, long-term oriented approach. If you are younger and you kind of have a greater familiarity or exposure to the world of these newer assets and you're comfortable with that, great. But understand the risky, inherent, unproven nature of them and right size exposure to that. You want to be the casino, not the gambler. You want to build a portfolio in a methodical way. Go back to that podcast again that we talked about in prioritizing, building that foundational part of your portfolio, right? The architecture is going to think of, or the architect is going to think about the frame and making sure the foundation and framing of your house is as strong as possible so that thing stands the test of time, and building a portfolio is no different. So regardless of what generation you're a part of, you do need to kind of take a step back and try to, depending on where your starting mindset is, ask yourself, what does the data tell us? How can I stack the odds in my favor? How can I better improve my discipline, whether it's on the saving or spending side, so I can have this lasting, incredibly strong foundation and house, right, or portfolio to meet my needs. At the end of the day, that's what we always like to reframe this conversation around. Well, money is a tool that is there to accomplish what's important to you. We want to build the foundation and the overall structure to accomplish that. So hopefully that's helpful. Great question. We love them. Keep them coming. It helps us orient these conversations in a way that's way more interesting and meaningful to you all, the listeners. So please, Mena, give them your number again. You can always text Mena a question or a topic you want us to cover.
Yeah, 626-862-0355.
Cool. Until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.